Good morning, everybody. This is Patrick MontesDeOca with the Equity Management Academy live trading room, live streaming from Ticket Talker. We have some really fast market conditions this morning in precious metals. Gold trading less than 1773.60, silver at 2605. Gold was down to about 1761. 90 in that vicinity early this morning, and we're back up to 1773. We have some fast market conditions basically, and let's just watch the market here for a little bit while I try to adjust some technical issues that we're having here with the robot. But fast market conditions. We have covered all of our short positions here at the opening. If you've been following us, cover all the short strategies, short positions. A close above 1780 is going to confirm the bottom in the market, but we have activated buy triggers from buy 1, from buy 2 on the daily signal, and also on the weekly signals. So cover your shorts, stay long, net long, and just hold on because I think we might have completed the correction. We'll keep you updated here. Please stand by. The target is 1778, 789 for the gold market here on this signal. We are strictly following the rules of the variable changing price momentum indicator. We're not taking into account any fundamentals, but simply following the artificial intelligence of the VCPMI. Cover all short positions here. Hedges at these levels here. I am covering short positions here, so bear with me here. I'm executing and covering my short positions as well here. The market has given us an opportunity to cover the short positions, basically, that we took, and now we are getting and reverting pretty much to the long side. If you've been watching my videos here for the last few episodes at least, we have made a point of saying that we are always carrying a core position underneath the market, and we're using the short end of the market basically to trade and to give us the opportunity to lock in some short-term profits here that the market is giving us an opportunity to do that while we maintain our core position basically intact. And in doing so, we pretty much also alleviate some of the stress, you might say, that the long-term core positions suffer as a consequence, obviously, of some kind of a correction. But we welcome corrections here in this market, and we are adding actually to the positions. We have just realized in closeouts for my real account here, $4,000 here for the day. We are carrying an open loss position, but we are adding to that position on these corrections here, as I feel that we've come down to what the VCPMI indicators are, or the AI is recommending, is that we have completed this correction here, and you want to cover all shorts and get on the long side. A confirmation, a very strong confirmation, would be a close above 1780. Basically, that would confirm the daily and the weekly numbers. Now, this morning, we came down into the weekly signal here that you see of 1761, which also coincides with a 50% Fibonacci retracement, and for all intents and purposes activated a weekly buy signal within 10% margin of error of the pivot point that activates the AI. And of course here, crossing above 1767 decisively activated the buy 2-level daily. It integrated the daily with the weekly, and the daily follow through on a close above 1771. Now we have targets of 1779 to 1780 for the gold. If we close above 1780, then it confirms the bottom is in, and the upper targets that we're looking at are all the way up to initially 783, 791, 796, and 1799. Right above it, we have the weekly target of 1814. So right now, the weekly target is telling us 1780. The weekly average, that's the next target. We close above that. 1796 is next to 1814 on the weekly number. So let's continue to just watch the market here as we cash in the short end of this correction. It looks like today the gold market is leading the way on the way up here. So keep that in mind. The gold market is leading the way. The 1761 level is a very strong signal because it coincided with a Fibonacci retracement of 50% Fibonacci retracement. And essentially this retracement is based upon the low made in March 20th to the high that we made on August of 2089 approximately. And this is a 50% correction. And by all technical standards, the completion of this consolidation came to actually a Fibonacci retracement of 61.8%, which was that 1685 level that we saw on the 30th of March. So we are breaking out of this downtrend or descending wedge that essentially confirmed the completion of this correction here back on April 15th, when it closed above this wedge, you might say, at 1764. And we came down here today and stabbed once again into the area where we identify the blue zone. The blue zone is a mathematical probability model that identifies in that area to be 95% probability that we're going to see a reversion back from these levels to the upside. This is the AI, the artificial intelligence of the algorithm, telling you that this whole week, if we come down to these levels here, there's a very high probability that we're going to find buyers. We came right into the Fibonacci trend line, fans, a trend line resistance. We broke that resistance and became support. We tested that and also tested the codes below, reverted from there. And now a close above 1780 is going to negate this bearish price trend momentum, and we're going to kick in the bullish trend momentum to the upside, which puts into targets the 1796 to 1814 on the weekly note. The monthly target, again, 17 and 99, 1800. So 1800 to 1814 is my ideal targets for gold here over the near term. We are consolidating above the 1771 by one level daily with the targets of 1779 and 1780 activated. There's no guessing. There's no wondering what's going on. There's no chatter. This is strictly an emotional trading, mathematical trading, systematic trading, algorithmic trading. If we get this confirmation by closing above 1780, then I think we're going to have a fairly strong rally into the middle of May, possibly the 28th, between the 15th and the 28th of May is the next cycle time and price projection using the VCPMI cycles. Right underneath 1762 today, 6180, which was the low made today, we had 1754 as the targets. And the top left of the chart that you see is the 1810, which is the 360-day cycle average price. So these levels here that you see are targets that upon completion obviously activates the higher or lower price fractals. And if we get the market to close above 1810, I think the party will start for a rally into that 1900 handle. Once we're able to get through that 1800 handle, we'll be looking at the 1900 handle as the target. One of the sectors you might say that we're watching very carefully is the 10-year bond, which I believe, is leading the parade, so to speak, of government bonds and interest rates, which is the cost of money, basically. What we saw here was a rally to about 177. We corrected back down to about 152. But as you can see, the pattern reverted yesterday, and interest rates rallied yesterday, which was a great reason to sell the metals. So interest rates, or the 10-year note, is beginning to anticipate the possibility of some kind of inflationary pressure in the system. As we, as we take a look at, as I pointed out yesterday, the CPI, the Consumer Price Index, is showing inflationary pressures. Obviously, if you factor in the complete formula, including food and energy, we have a different measurement in inflation that is a lot higher than what the Feds are saying. So who's telling the truth? The Feds or the numbers? And I think the market truly has not yet reflected in these values here. When if we go back to my trading room here for a minute, I wanted to point out, and I pointed out yesterday, in fact, and I'm going back to this chart that indicates everything is exploding in price. Energies almost 30%. Livestock, stock indices, industrial metals, agricultural, except precious metals. This is the S&P GCSI index spot change in 2021, commodities performance. You can take a look at all of these products here: platinum, palladium, aluminum, copper, are exploding. Feed of cattle, soybeans, natural gas, wheat, except for silver, nickel, cocoa, and gold. Gold is the most undervalued asset across the board. And I truly find this anomaly as the most incredible trading opportunity in precious metals. You take a look at precious metals in relation to just the economic landscape that we're dealing with right now, and the prospects that only indicate very negative signs for the US dollar as the world's reserve currency. So what is it going to happen? What is going to happen to the US dollar is my question. On the face of all this record stimulus, the market is not reflecting that yet, ladies and gentlemen. You have to take a look at the price of gold down, in comparison to all other assets, down, 6-7%, while everything else is exploding. It doesn't make any sense when you look at the gold market and silver market as a hedge against inflation. And even if you analyze the crude oil to gold, gold to the stock market, wheat to corn, soybeans to corn, there's a relationship. There's an in a market relationship, particularly in the grains, that is used by the industry, that is used, pretty much by end users, you might say, or commercials, which kind of fit in into the category that in commercials, usually you're talking about central banks or the other side of the gold market, the other side of the metals. And I'm finding certain things that happen. For example, if you take a look at the expiration of pretty much the options, for example, during this month, or if you take a look at the activity in the market into expiration, there's always an overflow of supply that is artificial that comes into the market. And as we move into the expiration of the month, you might say, or the expiration of the options in gold and silver and derivatives and so on for the month of April, we see this reversion into the expiration of the contract. We saw it in March again. And if you take a look at a chart every month, it occurs. It has the same pattern. The same pattern at the end of the month. And to me, that is not a coincidence. And particularly when you look at the open interest on the COMEX and you look at the open interest of the Commitment of Traders report, the COBT report, which publishes weekly who the players are in the futures markets, which is the leading instrument pretty much that is used for price discovery in the futures markets. Commodities, metals, interest rates, even the stock market, E-mini S&P, NASDAQ. The futures markets is the most liquid instrument that can be used, particularly for hedging purposes. It was created primarily for that purpose, outside of the speculative aspect of it. But I do believe that there is a concerted effort by the hedge funds, commercials, to control the price. The fact that the price of gold is down to where it is on the face of commodity prices exploding is an anomaly. It is probably one of the most frustrating issues that the market has created as far as the precious metals are concerned. And the only thing I can say to you is that it is an understated natural element, natural resource. It is an understated metal that essentially has been God's money, divine, money, so to speak, that has kept us pretty much alive during any crisis that we've had in the monetary system. You can go back to history. History repeats itself. Going back to the 1700s in France, and when currencies implode, gold and silver have been the currency for thousands of years to get us through that mess. And I'll be honest with you, I do not believe it's going to be Bitcoin. There is an incredible move right now that is pushing virtual currencies to unprecedented levels. But they are virtual assets, in my opinion, and to accept it as a currency worldwide, I think is going to have some real difficulties, issues. So, what most people don't seem to understand and see is that back in March, as a consequence of the pandemic, the economic system was forced to accelerate its technology process and move into a virtual economy a lot sooner than anticipated. The pandemic has caused major shifts, accelerated technology to, I think, the maximum as a consequence of the pandemic that we had to adjust to, or, if we didn't have this incredible transformation, change in the paradigm, as we saw back in March and late in March right away. And I think what the stock market saw was exactly the beginning of that paradigm. And obviously, it's certainly confirmation, because we're trading, the mini S&P 500 at, 41, 4,200 record levels. We were at under, I think in the 2,900 area, in that vicinity back then. And that is, I believe, why we were able not to go into a deeper depression than the 1929. Actually, the reality, if you take into account and you measure the time frame of the volatility that it took place, it was worse than 1929. The difference is that it happened in 30 days and it recovered in 30 days. And that never happened in the history of the financial markets. And when you look back and you reflect upon that, it was worse than 1929, but the recovery was also historic in its nature. And this is what we're beginning to sense, is that the Main Street sentiment, the Main Street consciousness is catching up to this change in paradigm that we've seen. And as we begin to open up the economy again, and as we begin to normalize our lives personally and business-wise, we're moving into this whole new landscape that we've never experienced before. And I know there is an incredible desire to go back to normal, to feel normal again, to feel you can travel, to feel you can go to the street or, have some kind of a normal life. There is an exuberance that I believe could be dangerous in terms of how fast we go back into the economy, how fast the velocity of money goes into the system. And when you really think about Main Street is flooded with money. People don't even want to work because the money that the government is giving them is more than they make in their jobs. It's unbelievable. And the system is flooded with money. The M2, the M1 has increased substantially, 25, 30%, I believe, the balance sheet of the Fed. So the money supply is exploding. And I believe that is going to come back into some kind of an inflationary surprise, just on that basis. Now, when you take a look at the supply chain, which has been broken, it adds to that equation that not only we could come back into an economy that is in short supplies, but in very much high demand for products that we don't have. Plastics, computer chips, real money, silver, gold, cash, physical assets is where the money, the real money, even the fiat money is chasing. Particularly fiat currency is chasing real money now. Real money has become a hot commodity as a commodity, if you look at money as a commodity. And real money is you owning some form of silver, gold. You can trade the virtual currencies very successfully. I love the volatility. We've been trading it, but again, I do not consider it to be a currency. Now, if we move into this virtual world economy more than we are, and we begin to integrate just about everything to match, you might say, the real economy, then we probably are going to need some kind of a virtual currency to deal with that virtual economy. It only makes sense. As we move into and migrate into another economy, the virtual currencies offer an economy without debt, while the old fiat currency is being devalued, being imploded intrinsically, possibly all the way down to zero, as we continue to print our way out of this old physical economy. And it is my opinion that this is not an accident, because this is the only way, the last hurrah, so to speak, or the last way for the government or for governments globally to reduce the world debt, by pretty much collapsing the currency the debt is in, which is what Mexico did in 1981. They devalued the Mexican peso against the US dollar from 16, it went to 40, from 16 to 46 literally overnight. And it went to hyperinflation after that. So there went the debt in the old currency, as they pretty much transformed that debt into hyperinflation. And I guess you know who paid? Who always winds up paying for all of these mistakes is unfortunately Main Street. It's unfortunately us. It's unfortunately particularly the middle class, which has been literally wiped out with this pandemic. One of the things that I'm doing here, ladies and gentlemen, sincerely, is to share with you an instrument that you can use to change your life. It has changed mine. It has affected and changed lives of other people that have learned to use this instrument. And, you can see it live here. I've been doing this for a couple of years, live every day, showing you how to apply this, and not necessarily, telling you how great of a trader that I am and how much money I'm making and all of that good stuff. I don't need to. It's there. You want to see it, you go to my website, you see the results. I don't need to sell the results. But what I am sharing with you is this most incredible artificial intelligence tool that is a probability model that you can empower yourself, whether you're a self-directed individual, an institutional account, or home office account, to activate trades that will give you a high level of confidence. And that will make a big difference, particularly in terms of what size you do. There are extreme levels in the market, pockets in the market, that are extreme levels of the core essence of the market, which is really the supply and demand. And whether you're day trading, swing trading, or position trading, once you identify the average price of that time period, then you can extrapolate the levels above or below to give you high probability trades. That, for example, down here today at 1761, knowing that the weekly was 1761, gave you the confidence for you to cover your shorts, to cover any previous bearish strategies that you might have applied from the extreme above the mean of 1783, which was the sell one level. You see, so it's connecting the dots, ladies and gentlemen. This is as easy as connecting the dots. At least it has become after a while, obviously, but that is what a robot does. It executes the signals unemotionally. And the AI tells you, when you come down to blue, don't sell. Even though the market may come down, let it go down all the way, even if it's on the weekly. And then when it reverts, that's when the signal is of high probability. the short signals below B1, whether it's daily, weekly, or monthly, have only a 10% to 5% probability by the time they get to B2. They trade below B2, that pattern is pretty much completed daily, and then it looks into the weekly pattern. As you see here, it activates the weekly signal. It engages the market again into the daily patterns, and the daily patterns together with the weekly patterns begin to activate the momentum of the market. The signal is clear, and the structure is completely in place. Your entry point, your target, and your objective. Once the patterns are completed, and here you see the silver market activating buy triggers from the buy one level of 2602, then you can include any classic form of technical analysis. And one of the ones that we use is the Fibonacci fan line that gives us, or begin to give us, the levels where the fan line resistance could be from the low that we made here at 3:45 a.m. of 2587.50 to the recent high that we saw here at 2651. So we've completed the first the fan line, the trend line resistance, the first one, and the second one, it almost completed the second one into that average price of 2615. So we're looking at the market trading around this Fibonacci fan line. Now it's again hovering around there, identifying the momentum. Once we close about 2615, it would negate this bearishness below, and we're going to be looking at 2641 to 2663 in the silver. So we still seem to be doing a little bit of work here at these levels here. We want to allow the market to trade in the area of what it identifies to be is accumulation of supply. This is where you're going to get trading buyers and sellers accumulating supply at these levels here. There is no guessing with applying the VCPMI. It's completely systematic, methodical, robotic. So it gives you that perspective that essentially, takes you away from the chatter, takes you away from the rumors, and it tells you exactly what the market is doing and what it wants to do and where it wants to do it from. And that's what the VCPMI does. It identifies for you exactly where that variable price momentum indicator will identify the momentum of the market. Continue to hold your long positions patiently. The target for day traders are 1780. For core position traders, we are net long. We have covered our shorts, and we're looking for the market to challenge that 1810 area, which is the 360-day cycle average price. Have a great day, my friends. Be well, take care of yourself, and I'll talk to you next time.
The risk of loss in trading commodity interests can be substantial. You should therefore carefully consider whether such trading is suitable for you in light of your financial condition, and considering whether to trade or to authorize someone else to trade for you. Past performance is not necessarily indicative of future results.
Patrick, I know from our previous discussions you have a somewhat different background than many typical traders. Can you share with us, please, how you got started in the markets, and what about the markets first caught your interest?
This is my my screen of all of the algorithms now that I've written in terms of the markets, and we cover all of the markets here. We got about 80, 90, 80, 70, 80 algorithms that we cover in the most active markets. And so, one of the things that I kind of became attracted to were the technicals of the market at the time. I didn't understand the difference between technicals and fundamentals. And a lot of people still don't know how to trade the market to make a choice as a trader, whether you follow the fundamentals or the technicals. And trading the fundamentals and the technicals became a real confusing process for me, because sometimes the fundamentals were the opposite of the technicals, or vice versa, or sometimes you would get a move in the technical side, but the fundamentals would vary. So it was like, how does one kind of reconcile that? And of course, once you begin to understand the dynamics of the market, which are primarily the exchange of the supply and demand, whether you're day trading, whether you're swing trading, or whether you're position trading, then you focus on the core of that energy, or what makes the market. And so when I was there, one of the things that I learned was resistance levels, support levels, for example, moving averages. At the time, I remember the charts were done by hand. It was, unbelievable. So we would have the clerks there sitting with all the charts by hand, and, they'd be, given signals, so to speak, on that basis. But they were delayed. By the time you got into a chart and you figured out a breakout point or a great signal, it was too late already. You couldn't catch up to that. And slowly, as I began to understand the function of the market, supply and demand, and I began to see how my trading was not successful by following the fundamentals, for example, by following the news or following the herd, so to speak, until I began to understand the function of the reversion to the mean principle. For example,
So I'm sorry,
I would give
just so our audience knows, you said reversion to the mean. Yes?
reversion to the mean.
Yes, okay.
It's basically a universal formula that you can find anywhere, pretty much, in terms of, let's say, daytime, midday, and nighttime. Midday is the mean of day and night. Our temperament, our emotions, sometimes we get over emotional on one hand, over happy or depressed. We go to extremes. And so what I began to see, for example, in my own trading, which is how you learn this, is that every time I would buy with a, let's say, a monthly breakout, 95% of the time the market will revert back. It will go down. If I was buying, it will go down. And it will go down sometimes, 70, 80% before it found, again, a whole wave of buying. And so, and I did a lot of options business. Therefore, obviously I lost a lot of money, because if you're wrong on timing when you're doing options, your time decay goes against you right away.
Yes.
And therefore you need a bigger, move on the upside to compensate for that loss intrinsically. So, once it made sense to me, so to speak, that movement, I began to see a lot of similarities with me, that the majority of those conventional technical moves, for example, on a chart, are usually contrarian signals that you should sell into, for example. Or for example, when the sentiment, if you measure sentiment, and there are ways to measure sentiment, when it's up above 80 or 70%, just like the relative strength index, for example, it's a good way to measure the momentum of the market. And so I was determined to find out why, when those conventional signals, for example, gave a breakout, the market reverted, right? And then I began to read Elliott Wave extensively, study wave counts, patterns. I read quite a bit of, again, I studied some of the most prominent gurus, so to speak, technicians that I believe were along the levels of study that I wanted to do, which was to measure wave patterns, to measure energy of the market, beyond price, because one of the realizations that I came to was to realize that price is a consequence of the energy behind the market. And so it made a lot of sense to me that if there was a way to measure that energy prospectively, then price will be a consequence. Price will be a confirmation. And therefore, it clicked to me that that was the driving force when you see, for example, a lot of these thrusts that go into this breakouts, logic of the reversion to the mean principle. And I began to see that prices, no matter how extreme they go, above or below its average price or its mean, they usually retract back. It's almost like a rubber band that you pull. The levels of energy in the market, which are basically what we're talking about, is the magnetic field of the supply and demand level of the extremes above and below. And so if you push the price way, way down, let's say to the blue level, which represents the buy level on the algorithm, what happens is the physics explodes the inverse. If you push the price up too much, up to the extreme, above the mean, the price collapses.
So that and
So
is your mean reversion.
that's the main reversion, exactly. And if you go to my profile, what you can see is that I've simplified all of this intelligence into basically the layouts that we have, where you can see, you know, the layout of the algorithms daily that we post. You can see the signals that are produced based on the algorithm. And we're putting together some phenomenal courses here to pretty much teach you how to use this algorithm for your own benefit, according to your profile and according to basically, you know, the account that you have. I also have written a book which is called Mean Reversion Trading. For those that are interested, feel free to contact Ticket Talk or here. I'll be more than glad to send you the book, and it pretty much explains in detail the different functions that create the algorithm, which is actually algorithm that